So today is Ask Me Anything Friday. So go ahead and in the chat, put as many questions as you want, anything that I could help you out with. And we're going to start with Phil's question here. Can you explain the rationale and backtesting that you conclude never hold the week before expiration? So the week before expiration, we have what's called gamma risk. Now, gamma risk is not when the Hulk walks into a room full of radioactive spiders. Gamma risk is what can happen when an option that you own falls out of the money and you can't do a damn thing about it, right? So gamma risk accelerates between the last week and the last day. Basically, it ramps up until the very last moment, and then the option has expired, right? So let's look at a couple examples here. We're in AMD. We're going to go the 220 strike here. Now, that would be actually, no, let me go with a different strike. Let's go with the 225 strike. All right. This has a delta of 80 and it expires in 6.5 hours from the time I'm recording this. Now, if I go to 1 week out to the 225, this has a delta of 65. Okay. Now, if I go for a week out, go the 225, this has a delta of 63. And if I go one more for the example, and I go to 225, this has a delta of 61. Now, what does that mean? That means we're getting more and more certain that it will expire in the money. Remember, 61% certainty of expiring in the money, 63% expiring in the money, 65% certainty of expiring in the money, and then we have an 83% certainty of expiring in the money. Now, gamma risk is the so delta measures the $1 change in the underlying $1 change in the price of the option for every I'm totally stumbling over my tongue here. Delta measures the change in the price of the option for every $1 that the underlying stock moves. So for example, on the 225, if AMD moves $1 today, this option will go up by 83 cents. If we go out in time, this one here will change by 62 cents. Okay. But that ramps up. You'll see this goes from 5 deltas. This is 6 deltas. This is 5. This is 5. This is 5. This is 3. This is 4. This is 3. This is 3. This is 2. This is 1. Okay. So the deeper in the money you go, the gamma contracts. It gets smaller. So meaning that the change in each strike doesn't have as big of an impact when you go from strike to strike to strike. However, when you get closer to expiration, you'll see this ramp up bigly, right? It goes from 52 to 63, just moving one strike. So that's 11. This is 10, and this is 8 to move from one to the next, right? Now, because of that, gamma risk is heightened, okay? Gamma risk is the risk that if it expires today, that it will fall out of the money. The 225 right here will fall out of the money. If AMD goes down by, let's say, $10 today, okay, down to 222, this option has no value. Prop time. This option has absolutely no value. And when I mean no value, I mean this pressed penny that I got from the Houston Museum of Natural History is more valuable than what your option will be when it falls out of the money. Because it can fall out of the money very quickly, your gamma risk, which we just talked about how gamma is so much bigger close to expiration and smaller further away from expiration, and gamma is the change between the deltas. Look, this is nerdy stuff here, okay? Your gamma risk is enormous here, okay? So and in fact, if you watch this, go watch it today. It'll be interesting to watch. The closer the time ticks by, the more likely that one of these will be in the money and one of them will be out of the money. And the highest gamma risk will be at the money because we don't know if it's going to be in or out. We don't know if it's going to have any value or absolutely no value. Okay. So never hold the week before expiration, which was the question, eliminates that. Okay. Because if we rolled it today, let's say we had the October 17th and we rolled it today out in the future. Well, that gives us more time, right? If the 232 current price goes down by $10 to 222, yeah, it's out of the money now. But I still have time, right? Now, I'm not saying that I would have held it, but there is still time value associated with that option, okay? So it's not going to be worth 0 if it falls out of the money. It might be worth $8, right? Because it has $8 of extrinsic value, but it's not going to be worth 0 like this one will in just a couple hours. That is why we roll out in the future. That is why we don't want to hold up to the week of expiration, because we want to make sure that we get out of the way and eliminate that part of options, eliminate that risk in options. Okay. Um, let's see. So Luke Newcomb had a great question, super easy question to answer over in our Discord. I'll pop open Discord here. Where are the plans located? Chris, give me the plans. I gotcha. All you got to do is go into the FAQ and member contributions. Right here at the top is the Google document. You click that, you got it. And what's great about it being a Google Doc is that as I make changes, they will update and reflect here. And then you'll always have it as current and up to date as you possibly have it, right? And what's great about these as well is that we have all the back testing data to go along with it. So there's no more trust me, bro. No more trust me, bro. Let's see. So Nate has a question on the Vega. Okay. So the options delta, I'm sorry, the options Greek of Vega is the implied volatility. Now, that is baked into the extrinsic value. Okay, extrinsic value is going to have your time decay. It's going to have the following, and it probably has more that I don't even think of. It's going to have time decay, which is theta. So every day, every moment that ticks by, theta is ticking by, and that is eroding the price of your option. Now, you're probably saying, well, no, I don't want that. I don't want that to happen. It is an unavoidable circumstance of having leverage. If you want leverage, you got to have theta. Okay. Then there is Vega, which is what Nate asked about, which is the implied volatility. The implied volatility is the expected moves of a stock, right? Now, that can expand, right? If news comes out on AMD today, that Vega is going to explode. Vega is going to explode until we get more certainty. As we get more certainty, that Vega is going to contract, right? And then there is rho, which is the impact of interest rates on the price of the option. Forget about rho. Rho never matters. Rho is going to matter to you if you have leaps that are like 5 years out in the future. For everybody else, it doesn't do anything. And all of that is baked into the extrinsic value. Now, intrinsic value is so easy because it's just your current price minus the strike price. That's it. That is it. There is nothing else in extrinsic value, meaning the difference between intrinsic and your ask price, because you're going to pay the ask, you're not going to pay the bid. The difference between the intrinsic and the ask price is going to be the ask price is going to be your extrinsic value. Everything else is baked into the extrinsic value. But there you go, Nate. Tosh says he's having an issue with the Discord link. Tosh, you should be able to get to it. So once you're in the OVTLYR platform, over here on the far right, I know the chat window's in the way. Over here on the far right is a Discord link. Let's click that. And it'll get you right in. It'll get you right there, my friend. That's the easiest way to get to it for sure. And hey, we're super stoked to have you. Everybody say hey, Tosh. Everybody say hey, Tosh, to let him know how much we appreciate that he is joined the OVTLYR crew. I will not compete in Hell's Kitchen because I am no chef. Ryan says, I'm new to options trading. Is there an intro to options YouTube video? So we have a whole playlist on my channel or the OVTLYR channel called Options Deep Dive. Go in there, start watching it. Now, of course, there's going to be a lot, right? The wonderful, amazing thing about options are the leverage they can provide you, the capital efficiency they can provide you, the lifetime generational wealth that they can provide you. However, there's a lot that goes into them. And I totally get it, right? I remember, Ryan, the first time that I ever looked at an options chain, and I've told this story many times, but I specifically remember the first time I ever looked at an options chain. I was working in my consulting job, and my boss was talking to a colleague of mine, and they were talking about Deutsche Bank. And they're going back and forth about they think the price of Deutsche Bank is going down. And I remember my boss saying, well, if you think that the price of Deutsche Bank is going down, why don't you go buy puts on it? And I was like, hang on. I remember hearing that before. So I was one of those nerds who kept all my books from college. And on my desk were all my books from college. And I picked up this book right here that has, I believe, 800 pages in it. Let me take a look. Oh, 600 pages into it. And there were 2 tabs on this book here. 2 tabs. One of them is options. One of them is bonds. Now, this is back from somewhere between 2004 and 2008. And I opened it to that page and it talked about how put options increase in value as the price of the stock goes down. And I was like, oh yeah, okay. And so I Googled giving an options chain or whatever, right? And I remember it was Yahoo Finance that pulled up, and I remember seeing all those numbers, right? Seeing all these numbers just like this, and being like a deer in the headlights right there, Ryan. I get it. And I remember being like, oh my gosh, I have no idea what all these numbers. I remember specifically thinking this to myself. I have no idea what all these numbers mean. I just want to make money. So Ryan, I want you to know you are not alone, my friend. But that's why I do the options deep dive every Wednesday morning. We do an options deep dive. We have a whole playlist on options deep dive, and OVTLYR University, which I've taught everything that I know in OVTLYR University, is also for free here on YouTube. By far, hopefully, the best education you could get with a 100% money back guarantee. So I hope that that helps you out. Antonio asks, do plans A and M have the same trading days and timing? Yes. Waiting 2 years for these. Who's waiting 2 years? I'm not waiting 2 years. No. Now, Antonio, I have to work on your trading psychology right here. Now, I'm going to pull up a slide from one of my mentors, Mark Minervini. Now, Antonio, these had, in fact, there's no trust me, bros. Let me go to the data. So it is the same number of days for A and M because they have the same entry signal, with the exception of one being swing signal and one being active signal. So it's 93 days over the span of 5 years. Now, Antonio, I don't want you to think that that's a problem. Okay. 93 days over 5 years means 20 trading days a year. There's roughly 250 trading days total. So about 10% of the time is a opportunity for a entry signal, right? Now, just because it's an entry signal, you have to find an exit signal, right? Now, those exit signals are probably going to double the number of days that you're going to be trading, okay? Because you're not trading on the entry signal and trading out on the exit signal on the same day, of course. So honestly, realistically, you might be trading about a third to maybe 40% of the year. Now, that actually holds really strong to the anecdote that I heard that the market trends about 40% of the time. The other 60% of the time, it doesn't. Now, why do I want to mention that? Because in those 93 trading days over the course of 5 years, the average expectancy is 2.25%. So let's just do some math here, okay? Let's say AMD, we took a trade on AMD and it went up 2.25%, okay? Let's say, and that's the average, right? Some of these are going to go be way, way, way bigger. Some are going to be smaller. Some are going to be losses, okay? But on average, the total average outcome is a 2.25% positive expectancy, okay? So let's say that I went to the October 31st AMDs and I bought the 80 call for 32.80, which is really pricey, really, really pricey, 32.80, okay? Now, if AMD, in fact, I'm going to need a spreadsheet for this. You're going to like this. This is one of the reasons why I tell you guys to wait patiently. And in fact, my mentor, Mark Minervini, this is his number one rule: wait in cash for proper setups. How long? As long as it takes. Now, in our instance, we're waiting in plain ETF for as long as it takes. So let's do some math here, and you're gonna love plan ETF. Okay, so or plan M and A. So let's look at AMD was at 232 right now, 232. Okay, this is current price. And then let's say this times 0.25. No, 1.0225. Okay. So we go up by $5 to hit that that average return. So projected. So that would be the average expectancy. Okay, that's what I'm trying to say. Average expected projectancy. Expectancy projected. Now, you're like, no, that's not all that much. It's really not. It's really not, right? It's 2.25%, which is $5.22. Okay. But if we apply leverage to this, let's say I bought the 3280 and it has the 80 delta. Okay. Let's say I bought the 3280. The cost of the option was 3280. Now this times 80 delta. Okay. So 0.8 times 0.8. All right. That's not what I want. What I want is this times 0.8. Okay. So as it goes up from 232 to the 2.25% expected move, average expectancy, it would gain $5.22. Now our option would gain $4.17. Okay. Because this is an 80 delta option. Now, this divided by the original cost means that we would make 12% on the option versus 2.25% on the stock. Okay. Which means this divided by this, by taking the option, we're getting 5.66x return. So 5.6 times more return by doing the deep in the money options versus just the stock on its own. Now, we're not even talking about capital efficiency here, because let's say that we're just doing one lots here, right? If we did this times 100, that'd be $23,000. You'd have to put up $23,000 to buy 100 shares of AMD. But this times 100 is 3,200. Okay. Now, this divided by this means we're basically getting a 7-to-1 leverage on AMD. 7-to-1 leverage on AMD. Which, when you take the delta, is why it comes out to about 5.6 x higher returns doing it that way. Isn't that cool? Gotta be cool, right? So, with that being said, I would highly recommend waiting in cash for your trade to set up. Now, here's the thing, is that I would encourage you to figure out what your own plan is, right? These are my plans, right? You don't have to follow my plans. There's no reason to follow my plans. I mean, I will be winning the US Investing Championship in the Options and Enhanced Growth Division next year, but you can do whatever you want, right? You can do whatever you want. In fact, I would also say that anybody who follows my plans would have potential, and I can't say I guarantee anything, potentially similar results as to when I win the US Investing Championships in the Option Enhanced Growth Division for 2026. Like, I can't be more serious about this, right? We have an entire team, Antonio, and everybody. We have an entire team, Antonio, dedicated to finding the highest expectancy possible. Our entire OVTLYR team has one goal, and that is to make the best strategies possible that everybody and anybody can implement, and to do that live so everybody and anybody can see for a cost of nothing just how great it is, just how life-changing it can be. Okay? We take this so seriously, my friend. We want to make masters of the universe money. Let's see. Samuel says, are active signals and swing signals only for the stock and sector, or does the market differ with active and swing? Okay, so inside here, you can pick any stock, right? I'm literally going to pick one at random. AAODI. So in here, we have two different types of signals. We have swing signals and we have active signals. On all ETFs, they are the same. However, on individual stocks, AAOI is Applied Optoelectronics. This is in the tech sector, and it has swing signals enacted currently. Now, you can change it to active signals, and it is a global change. Everything in OVTLYR will change when you change from a swing signal to an active signal. And the active signals are more frequent than swing signals. Now, you can't have a buy signal that's an active signal unless you already have a buy signal that is a swing signal. So it's like a double confirmation. It's like a double confirmation. Now, in plans A and plans M, plan A is for the active signals. Plan M is for the swing signals. Plan M's expectancy, as I showed you earlier, is at 2.25%. It is a monster. Plan A's expectancy is at 1.227%, but there's more of them. Okay, they happen more frequently. And that was the whole point, is we want two comprehensive plans that work, whenever there are setups going to be aggressive, going to be offensive. I'm always offensive, but I'm not always offensive. And if these aren't working out, that's what plan ETF is for. And that's why I'm in plan ETF, is because plans A and M aren't setting up for me. And then if plan ETF gets a sell signal, which means that like nothing is good is happening, we're going to go to plan sit and cash and don't F up. Let's see. Stevie asked, can open interest be used as a guide to provide real support and resistance? I don't know. I've not used it like that. I only use open interest as a gauge to know if I do or do not have enough liquidity to get in or out of a position. Now, I have been in positions that I didn't pay attention to open interest, and I got stuck, and I got hosed on the exits. I mean, I got absolutely obliterated because I could not get out of a position. Now, this happens to a lot of people with penny stocks. They can buy as much as they want because there's somebody waiting to sell to them. They can't wait to get out. But then when this person gets into the penny stock, they want to get out. There's nobody there to buy it. There's nobody there to buy it. Open interest is the amount of people who are actively trying to trade this. Okay. It doesn't mean contracts. That means basically participants who are there saying, hey, I want to trade with you. I want to trade with you. Now, I like to have at least 250. Now, one thing that we have found is that the number of outliers who have all traded at the same time, we can absorb 250 like nothing. So you might even be able to go lower. But the rule of thumb is you want to have at least 4 to 6 times your position size. So if you're doing 100 contracts, you want to see at least 400 to 600, right? If you're doing 50 contracts, you could see 200 to 300, okay? So it really depends on the stock. But I have not ever used that as a real measure of anything other than, can I get in and can I get out? That's what I need to know. Jamie says, so with the gamma risk example, should we select options that are way beyond earnings so you can go through the trade and exit before earnings without that gamma risk? I mean, I always go for the 21 days to expiration. That's just my wheelhouse, right? You could always you could choose whatever you want, right? So for example, if I were to buy AMD today, it looks like earnings happen between October 31st and November 7th, okay? I don't care when they happen. I really don't. If I'm trading this, I'm going to go for the October 31st because that's 3 weeks out. The average duration of our trades is roughly 17 days on plans A and M. Roughly 17 days. So if I go for 21 days and it works, I could hold it until we get to 1 week out, and then I could roll it maybe a couple times, roll it out in the future. But once it gets to expiration is off the table. I'm sorry, not expiration. Earnings is off the table. Earnings is off the table. 55% of the time a stock has earnings, it goes down. Don't do it. Trading through earnings is like walking into the casino, taking whatever you had in your portfolio for that stock, putting it on black, and going, let's do this thing. No, F that noise. No, I am a sophisticated investor who wears Scrooge McDuck shirts on the internet, and I'm a fund manager, okay? There's the last thing that I'm going to do is gamble with my money. No way. No way. No way. Treat your account like a fund manager. And once you get to earnings, just get out. I know it sounds crazy, but part of our back testing actually showed that by getting out the day before earnings or the day of, if they happen after the market closes, increases your expectancy tremendously. Kevin says, what if 2026 happens? It's a choppy year and the plan doesn't allow entry. What if it does? So we can't tell the market when we're going to get paid. I went on a long diatribe about this yesterday. We can't tell the market when we're going to get paid, which is why I think day traders get absolutely hosed because they feel as if they need to make they need the market to pay them today. They need to feel as if they make a trade that they can, they call it their monthly nut. I need to make my monthly nut of $10,000 in order to pay my mortgage and all my bills and whatever, right? What if you don't get paid that month? What if the market presents you absolutely no opportunities? I guess you can't pay your bills. I guess you're going to go sleeping on the street, huh? We can't tell the market when we're going to get paid. Now, I'll give you a great example of this. My last 5 years returns, if I remember them correctly, was 2021. I guess that'd be 4 years of returns. 2021 was 172%. 2022, I was down 20%. 2023, I was up 5%. 2024, I was up 92%. And then 2025 so far, I'm up around 50%. Okay. I can't tell the market how much I'm going to get paid. The market is not your boss, right? You can't walk in and sign a contract and say every third Thursday of the month I'm going to get paid $10,000 in this case, right? It's not going to happen. You can go long stretches in the year of absolutely nothing. Oh, good. Now I can lead to my story. I'll give you a great example. Let me pull up my. Give me just a second here. I want to pull up my returns so far for the year, and I'll give you some perspective, because I went basically flat until May. Basically flat until May. Now this isn't updated with my plan ETF. It's closer to 50% now. I went basically flat until May. If I had to pay my bills from my trading account every month, I wouldn't have been able to do that for 5 months. And then in May, I hit a huge win. My total returns in May were 40.03%. And that 40.03% happened in between a Friday and that following Wednesday. 40.03% my account gained in 4 trading days. But that's the deal. I don't know when I'm going to get paid. Now, you'll also notice here that I had some drawdowns, right? And this is closer to 50% right now, thanks to Plan ETF. But what if I had said, okay, I need to get paid this month, and then I had a drawdown? I need to get paid this month, and then I had a drawdown. We can't tell the market when we're going to pay. I know I keep beating a dead horse here, but we cannot set any sort of expectations on the market. We can't. We can't. And when you do set expectations on the market, say, give me money today, that's when you're going to get into a whole heaping full of trouble. I would absolutely take the attitude of, if the market goes sideways for all of 2026, fine. I'll sit in cash. I'll earn whatever SGov is earning, and that's what it's going to be. But I would much rather do that, take one trade and sit in cash, and in this case, it's around 4% right now, and be up 4% for the year, than to be fighting and losing money and watching my account evaporate. And that's why we say sit in cash and don't F up when you don't have anything else to do. Because it's so easy to get into the mentality of, I got to do something. I'm a trader. I got to do something. But in reality, the only thing you have to do is sit and wait. The money is made in the waiting. I know it's hard, but the money is made in the waiting for the opportunities to come to you. It is not made in forcing anything. That's a great question, though. Let's see. So many great questions coming through. Will you still trade A or M if the only sectors are staples and utilities? Yes, because if your trade plan sets up, you have an obligation to take that plan. Okay. When I worked with Larry Height, the very first billion-dollar hedge fund manager, one of my friends, he is one of the original market wizards. He said pretty much exactly that to me. If you have your plan set up and you don't take it, then you have basically invalidated the whole point of having the plan in the first place. Now, that's for entries and exit signals. And going back to May, right? Going back to May, when I got my account up to 40.03% in the span of 4 calendar days. No, 4 trading days. More like, how many days would that be? 5 I don't know. Either way, 4 trading days. My account was up 40.03%. I wanted to tell you guys this story. So we are going to be sponsoring this podcast called Pull the Crown. I really want you guys to go and subscribe to them. I am a fancy watch guy, and these guys have a fancy watch podcast. Now, I know if you're not into fancy watches, I get that. But there's a huge crossover between people who like fancy watches and people who obviously have enough money for investing. Now, I wanted to talk to them talk to you about them because I'm having a meeting with them today to kick off our sponsorship. And this is Julian and this is Chris. And Mahesh, our CEO, and I were talking yesterday, and we were like, we want to teach them how to trade plan ETF. That is our easiest plan. It is our lowest maintenance plan. And if we can get them to be successful in plan ETF, then they will be successful and share that with everybody they can possibly know. Now, plan ETF is making money right now, right? Plan ETF is fantastic. In fact, there's a question about the OVTLYR fund, and I'll go over that in just a moment here. But here, we're trading plan ETF in this particular account, and it's up over $7,000. So the OVTLYR annual pass is $300. So 7,300 divided by 300 means this one trade in plan ETF would have paid for 24 years of OVTLYR. This one plan, right? And it's so simple. It is the easiest plan I've ever used ever, and it is making bank. Now, where I wanted to go with this was I want to tell the story of when this happened right here, this 40% move in my account, because I was telling it to them. They're like, oh, you know what? If we could teach people how to trade, then they can go out and buy more watches. And I was like, oh yeah, let me tell you a story. So my wife had student loans, and we got the letter in the mail that said, your student loans are going to be forgiven thanks to Joe Biden. He's the best ever, right? And we kept waiting, and we kept waiting, and we kept waiting. And my wife's like, we should pay these off. And I'm like, why? Joe Biden's going to pay it off for us. Why am I going to do that? And we kept waiting, and we kept waiting, and it never happened. And then, Donald Trump gets elected. He's like, yeah, whatever Joe Biden said, forget about it. It's never going to happen. And so, we're paying on the student loans again, the monthly payment or whatever. And then when that 40% move came, guess what I did? I took the money, I paid off for student loans, and I bought myself a fancy watch because I could, because I had the money to do so. That was the story I told them. And they're like, whoa, okay, that changes things, right? And it can happen that fast, literally that fast. Literally that fast. You can watch your account go from flat to 40%. Now, that's not normal, right? Let's give some perspective here. Going up 40% in the span of 5 calendar days, or whatever it was, 4 trading days. It's 4 trading, 6 calendar days. There you go. That's not normal, right? The normal returns, and I did a video just ranting about this. The normal returns are between 8 and 10% a year. So if you compound that, right, I basically got 3.5 years, 3.5 to 4 years of gains in 3.5 to 4 trading days. Not too bad, right? I'm not the only one who did it either. If you had incredible success in May, put it in the chat. Put it in the chat, right? Richard says, I've made back that 82 cents a day every day because my trading is 1,000% better. Outstanding, outstanding. So I really want you guys to understand that you can't force when the market is going to pay you. But when it does, and you have waited patiently and you have a plan, you can make Vuku bucks, as my mom would say. Vuku bucks. Brandon says, will OVTLYR be adding SLV to the list of stonks that it covers? Thank you. I thought we did have SLV. Hang on, I want to double check that SLV because we covered 2,600 of the most. Oh, I guess we don't. Let me double check. I didn't spell it wrong. SLV. We covered 2,600 of the most. No, we don't. Not yet, and that's okay. We covered 2,600 of the most active stocks and ETFs right now, and before the end of October. So sometime in the next 2 to 3 weeks, we're adding 6,000 more stocks and ETFs. So most likely it's going to be in there. I would be very surprised if in the 6,000 it didn't come through there. Corey has a very critical question. When will Lucy be visiting us again? I don't know. That's so funny. Lucy was a little bitty itty bitty baby dog that I dog sat for a week, and of course I used it to milk all the views I could. Let's see. Phil asks, is changing to a lower delta something useful or profitable? Oh, I would oh, so it sounds like you want to roll it. All right, now let's talk about rolling options. So It is one of my favorite ninja hacks in rolling options. If you have experienced the ninja hacks and rolling options, what I'd like you to do is put in the chat some of your experiences. So one of the amazing things about options is being able to roll it. So let's go take a look at this. SEI, October 17th, 45s. October 7th. Oh. I would be rolling this one out in time. This options grid is weird. There's nothing out of the money. That's super weird. Anyway, I would be rolling out in time on this one. So if I were in the 45s, what I would do is I would sell the 45s and then go out to here. And oof, I don't like either of those. All right, so my rule when it comes to expiration, hold tight. My rule when it comes to expiration is it already profitable? It sounds like yes. Can you roll it up or out for a credit? Well, in this case, if you roll it out, the 45 to the 45, it will be a debit. It'll be a debit of, oh, this is not great. It'd be a debit of $3.10. So no, there's no way. Now, objectively speaking here, Eric, I would be closing the trade today. And the reason being that I would close the trade today is I can't roll it up for a credit. I can't roll it out for a credit. My answer is to close now, 1 week before expiration, because then you don't have that gamma risk. Now, here's the deal is I'm going to be wrong. I'm telling you that right now. I'm going to be wrong. And this stock is going to rocket higher. And you're going to be like, oh, that guy, Chris, he told me to sell my shares. No, you're a big boy. Do what you want, Eric. Do what you want. But if I were trading it and it were my plan, that's what I would do. Now, as far as the rolling goes, let's get back to that. Why do we want to roll? It takes partial profits now. It takes partial profits off the table right now. And then it frees up that capital, right? So let's say you rolled it for $1. You can now go trade with that dollar. Like right now, you can trade with that dollar. And it keeps the trade alive. So what's really cool about this is like Keisha, she's up with 140% gain on CFLT, thanks to OVTLYR. Congratulations to you. And looking at this, right? Looking at this, you can actually get to the point where you have rolled it enough times where you don't have any risk on the trade. You have no risk on the trade, probably like Jamie has right here. He's up 205% on IRIN because he's been rolling it, right? By rolling it, it allows you to keep the trade on. But when you keep the trade on, you're taking in partial profits. You can't do that with stock. You have new capital that you can put on other trades. You can't do that with stock. The only way you can do this is by rolling your option. And let's go to a different one here for the example, because there's just not enough strikes here. Let's go back to AMD. And you would want to go from like the 217. So you'd just basically sell to close one and buy to open the next. And when you do, you take in that credit of $1.95, right? So in this example, we're taking a credit of $1.95, $1.85. Now, $1.95, $1.85 is about 10, maybe 15% of the original cost. So that means you've reduced your risk by 15% already right off the bat. You can now go trade with that $1.85. Maybe you found another stock that has inexpensive options and you can go buy, several of them at $1.85. It is such a cool hack. And you get to keep the trade on. Super cool, right? Let's see. Oh, there was a question about the OVTLYR fund. So the OVTLYR fund is something we're putting together. And this is what I will be trading in the US Investing Championship. Now, it's not my account. It is our OVTLYR fund account. At that point, I'll be managing 3 accounts. And the reason that we're doing it is, number one, to build our track record. Because at some point, we want to take this and make it more accessible to more people. And we need a legitimate track record that everybody can see, and auditable, everything right there in front of you track record. And trading it live, I think, is the best way to do so. And this will be the account that I use and win the US Investing Championship. It has not been funded yet because one of our partners, Mark, he has had some family priorities that have come up that have taken him away from working on OVTLYR. And because of that, we've not been pushing that to get it cleared. But that is the plan, right? It will be here. It'll be live on YouTube, and you're going to watch me take this account from, it's going to start at 30,000, which I think is the perfect place to start because 30,000 is really accessible, right? Now, for some people, 30,000 sounds like a ton of money. Like I'll never get to 30,000. To some people, 30,000 sounds like not a big deal, right? 30,000 is a great place to start because it allows you to position size at a size that makes sense. Because if you have too small of an account, let's say you have a $3,000 account, you could take one trade and it's your entire portfolio. So you have elevated risk there. If you had a $3 million account, and I'm telling you this because I've seen it happen time and time again, you get really, really lax in your risk, right? Now, if you have $3 million to trade with, I would say put that aside, start trading with 10,000, 20,000, 30,000, something like that, because you want to build up the skills so that when you are ready, you can throw in the rest of your big pile of money and know what to do. Because what happens to a lot of people is they start with a big account. In fact, the old adage is, if you want to be a millionaire in the stock market, start as a billionaire. Because when you have a big bankroll, you don't care about risk. There was a guy who sent me his portfolio one time, and it was a $3 million portfolio, and he had 90 stocks on there. Do you really think that he's keeping up with 90 stocks? No, of course not. It was like he went into the grocery store and he's like, I'll take one of these, I'll take one of these, I'll take one of these, right? He had no exit plan, no entry plan. He was just like, I got money, I want to buy it. And then he asked me, why am I losing so much money? Because you have no idea what you're doing. Just because you have a big bankroll doesn't mean a damn thing when it comes to the market. The market will be very glad to remove you of those dollars, okay? Very, very helpful to get you rid of those dollars. Scott asks, does it matter what delta is when you roll? So generally, when you're rolling, you want to have a trigger. So for me, when I'm rolling, I want to see my stock go up 1 ATR. Oh, and there was a question about what is ATR. So perfect. We'll put those two together. So down here on the bottom of my trading view chart is an indicator called average true range. Okay, it's just the basic one. Where is it? I think I got to go over here. It's just the basic ATR. Come on. Trying to get to show right there. It's not showing. Okay. If I do that, there it is. Okay. It's just the basic ATR calculation right there. 14. I don't even know what RMA is. I literally don't know what that is. It's the first time I've even seen that. 14 is the default periods for ATR. This is measuring the volatility of a stock over that number of periods. You could change it to 1. You could change it to 100, right? 14 is default. Now, as you'll see, we can zoom out a little bit. There was a point in time where the volatility, which means the average movement of the stock on the SPY, peaked in April. It peaked in April. And you can see these big candles right here, right? These huge candles. Look at the size of these candles compared to these candles, right? You could stuff like 23 candles in that one right there. You could probably stuff 15 candles in that one right there, right? That's your volatility spike, okay? Now, that doesn't mean that it's spiking up or down. It just means the size of the movements have gotten bigger. Now we come over here, it's at $5. And at this point, it's at $20. When volatility spikes like that, and it's 4 times bigger a few months ago than it is right now, you don't want to trade the same size. You have 4 times as much volatility back then as you do now, which means you actually could take a 4 times larger position today than you could have then and had the same amount of risk. Really, really cool thing to do. Now, let's talk about the ATRs here. Let's say that I bought the SPY and it went up by 4.66, which is the current ATR value. In fact, I got a little cheat sheet up here, bullish ATR levels. It went up 4.66%. So I would put in my opening line right here, and I would put in my 2 ATR line. I'm sorry, my 1 ATR line right here. So once it hits this area, once it moves up that far, that's when I know, hey, you know what? Now might be the time to get out. Now might be the time to roll. Now might be the time to do something. And so in my trading plan, when it moves up 1 average true range, that is my trigger. That is my trigger to roll. Now, as far as where do you roll on the deltas, I always go for the 80 delta, right? Let's see. I always go for around the 80 delta. You want to make sure you keep the same liquidity standards as you had before, whatever those liquidity standards are. In fact, I don't know if that slide made it into here. We are missing that slide. Just realized that. Okay. Position size calculator. but we don't have, oh no, we don't have a liquidity slide. That's okay. We'll get it. We'll get it. Oh man, that was an oversight on my part. Okay. But anyway, on liquidity, I want to make sure that it's at least 250 open interest and at least a 50 cent or less bid ask spread. Now you go over here and you're going to see lots of stocks with tons of open interest. But then you come over here and it's like a 85 cent bid ask spread. I'm not interested in that one. So maybe I'll move down a little bit. This one is a 45 cent bid ask spread. Oh, okay, I can work with that. Tons of open interest. Cool. That sounds great. Then you can go to something else like what was that one we were just in a minute ago? SEI. Not the most liquid thing out there. And look at this is $4 wide. This is 280 wide. This is $3 wide. Like this is not very liquid. Even though it has tons of open interest, the liquidity is bad. I know that sounds weird, right? How can it be super liquid yet have a huge bid ask spread? That just means that the market makers are pushing this very far apart. I don't know why. I don't really care to know why. All I know is that I wouldn't be trading it. I wouldn't be trading it. Now, what is the reason I wouldn't want to trade it, right? The difference between if I had to buy it at 960 and sell it back at 660 is $3, right? 960 minus 660. We know that's $3. But $3 divided by the price that I bought it for means I would have to take a 31% loss, a 31% loss to buy it and then sell it. F that noise. F that noise. That's the last thing that I'm going to do is take a 31% loss for the privilege of buying one and then selling it right back. No, thank you. So listen, we're going to bounce over into the invitation only live stream. And in this invitation only live stream, we're going to be giving away tons of stuff, right? We're going to be sharing what's going on in the Share Your Big Wins. We're going to be looking at somebody who's going to win something live. And we're also going to be talking about plans M, plans A, and plan ETF, and any moves that we need to make today. I would really highly encourage you to go over to OVTLYR.com, grab the annual pass for literally 82 cents a day, and then you can join us in these invitation only live streams, which are replayed later. But of course, you don't get to participate in those. And, I will be moving over to that right now. But in the meantime, if you're looking to save time, make money, and start winning with less risk, click one of these two videos, and we'll talk soon.